Hello, everybody, and thank you for being here tonight. This is the TrendSpider Technical Analysis webinar series. And today is Sunday, the 17th of November. It's a beautiful day. There looks like some people are still trickling in, so I'm just going to give people a moment to file in. And in the meanwhile, I'm going to put this disclaimer on the screen that the lawyers make us put up every time we do one of these. So, I mean, obviously, just what the disclaimer says, nothing we're going to talk about here is trading advice. Do your homework. Be smart out there. Investing and trading is a risky activity to undertake. Today's webinar is about developing and testing a hedging strategy. We've got a very special guest tonight. We've got Tom Basso, and Tom is a very experienced trader. We were just chatting about some of his trading, and he'll tell you all about it. And today's webinar is all about backtesting. So we're going to talk about TrendSpider's backtesting capabilities, and we're going to talk about backtesting in general. And then I'm going to hand it over to Tom, who will show you and talk about developing a strategy using the backtester. Before I get too far into it, I just want to make sure everybody can hear me okay. Can somebody just mention in chat that you can hear me and see the screen? Thank you very much, Ben and Brad and Tom. Thank you, guys. I'm happy that everything's working. So it's a lucky day when we don't have any tech issues. Okay, so just a brief introduction. TrendSpider is a charting package, right? We're a software tool. We're used by traders, and we are built to help traders be more efficient. We have a patent-pending technology platform. It's about 3.5 years old here, and over 4,000 traders use the platform, every day to trade and monitor and backtest and do all kinds of stuff across stocks, Forex, cryptos, and all kinds of different asset classes. Our platform is designed to be not just a different charting tool. You can get charts anywhere. Like, honestly, there are a million different charting platforms. You can get charts anywhere. TrendSpider is more than a charting platform. It's a tool to automate a lot of the grunt work that you do, to help you build and develop strategies, to help you monitor charts, and to help you kind of make the most out of your trading, right? Because we all have limited time and attention, and trading is hard and risky. So, we believe that tools and technology can really help traders improve. Backtesting, which is the topic of today's webinar, is a fantastic topic. It's also something that is largely misunderstood by traders and underutilized by people in the trading community. I know a lot of traders out there who've never run a backtest in their life, and yet they trade strategies that are backtestable. And to me, that's a shame, because backtesting is, in my opinion, the best way to develop, test, refine, implement, and put to work real trading strategies. David, if you can't hear us, you should probably click on the having issues with sound link above the chat box, or just refresh your screen. So back to backtesting. The concept here is pretty straightforward, right? We take historical price data and we test how a strategy would have worked against that data if it were traded perfectly. Meaning every time a buy signal occurred, you bought, and every time a sell signal occurred, you sold. You got perfect execution, right? There was no slippage. You got the best entry price, the best exit price, and everything worked out great. In real life, you'll most likely not perform as well as a backtest. So I really like to make that clear up front, that this is to give you a good idea, a very close idea, but it's never going to abstract real life conditions, because you don't know how wide the spread will be in real market conditions, right? Things can move pretty quick, and things can change pretty quickly. But nonetheless, despite those downfalls, right, and those are issues of every backtester in the world, it still provides an amazing way for you to get a good idea for how your strategies could play out in real market conditions. So what I'm going to do here is I'm going to flip over to TrendSpider. I'm going to give you a quick tour of the backtesting capabilities, and then I'm going to hand it over to Tom, and he can get into some actual strategies and talk about some really cool and fun stuff. But you'll have to suffer through some of this boring stuff that I'm going to show you here to get a little bit of a foundation so you know what we're talking about. So what you see on the screen here is a standard TrendSpider interface. We can turn on indicators. We're going to do that because we actually use indicators in our backtests. I'm going to keep it very simple here and very quick so I can get it over to Tom as fast as I can. But the general idea here is you then open the strategy tester and you can select a strategy to test. Now, a lot of traders like to trade things like, especially new traders, like MACD crosses. A lot of traders like to use very simple strategies that they find online, sometimes very complex strategies. But the point is, in every strategy, there is a entry condition, which in TrendSpider's backtesting tool is always a technical criteria, right? So here we have it set up to look for when the MACD fast line, which is, I believe, the blue line here. Yep, the blue line on my MACD crosses up through the orange line, which is the slow line. That is our buy signal. And the reverse, when MACD crosses down through the fast through the slow, that is our sell signal. Right, and here's where it gets cool. When I press test here, I'm testing over 7,000 candles. That's 27 years of data. And the system has found that this conditional set, right, MACD crosses, have happened 253 times on the daily chart. And you can see how those have performed. You can see how that has compared to buy and hold. Right, in this case, buy and hold would have outperformed, right? You would have done almost twice as well if you just bought and held Apple instead of trading it using the MACD. And you can actually see each individual trade that was part of that strategy on your chart, right? And this is something that's very cool and very unique to TrendSpider, right? When you conduct a backtest, the system will plot every trade in that backtest on your chart. And if there's an open position at the end of the backtest, meaning that the backtest was not, the last trade in the backtest hasn't closed yet, MACD hasn't crossed down yet, you'll see a cloud like this that shows you how all the past tests, all these 253 positions on average performed. And what's actually fascinating about this one, I did not set this up this way. This was just a random MACD strategy on a random chart. But you can see how well Apple's price action is following the past behavior from the past trades in this strategy. And that's a really interesting thing. And as you go back here, you can see each trade that was part of this particular strategy. Now, this is cool because a lot of people like to test a strategy out, right? But like something like this, you might say this is really noisy. And this is where our backtester is really unique because you can very quickly refine your conditions. You can now say, look, I want to buy when this is true, but also when some other conditional set is true. For example, I don't know, one EMA is above another EMA, and we can do a 10 EMAs above the 50. Or whatever we can dream up, and we can repeat the test and see how that affects our results. And in this case, it actually hurt our results, and we started to perform a little bit worse, right? When I click See on Chart here, it's going to refresh this, and it's going to update it to include all the new trades that are part of that strategy. A few other quick things before I hand it over to Tom, because I really want to give Tom as much time as possible. But I just want to highlight this. You can control when you trade in the backtester. So right now it's set to buy and sell on the close price, but you can do that on an average price. You can do that on a high or low, whatever you want. You can download the list of trades by clicking the download CSV file. This will give you a spreadsheet with 150 lines or 140 lines in it, showing each trade, its return, and whether, the reason for the trade. Right, and you can also configure additional conditions like a time-based condition, which is get out in 30 days, or a take profit condition, or a stop loss condition to refine your strategy and limit your risk and control, the performance better. As you play around with this, you can find strategies that work really well for you on certain charts, and you'll find that they don't work on other charts, and that's called curve fitting. And it's the holy grail in automated trading, algo trading, and backtesting is to find strategies that are not curve fitted. And it's actually very, very hard, right? But when you find one, right, then, you can trade on that for a long time because those are very rare. And, I would suggest you keep that very quiet and very secret, right? So other people don't come across it. But there's no better way or faster way or easier way to develop, test, and refine strategies than using a backtester. And I may be a little biased, but I truly believe that the one we've built here is one of the easiest to use and best ones out there. Last thing before I hand it over to Tom, you'll notice in the TrendSpider backtester, there's these little buttons. They say, alert me next time this happens, right? And if you really like a test, right? For example, like you may think that this is not true, but you may think this with whatever condition you're testing, that this entry condition gets you very good entries. You can then click this alert me next time button and have the system let you know the next time the chart has set up for you, right? So that's a cool capability that's in this platform. Most other backtesters that do exist out there aren't this refined. They can't backtest intraday, and they most certainly can't monitor and let you know the next time that's happened. So thank you for listening to that. I'm going to hand this over to Tom. Tom, can you hear me?
Yes, I can.
All right, Tom, thank you very much. And feel free to take over and share your screen.
I'm going to do it.
Awesome.
Let's see, the entire screen. There we go. All right. So what I wanted to do is I use TrendSpider for what I would call quick and dirty backtesting. Because a lot of my stuff's fairly automated, I don't sit there. As many of you know, I'm retired. I've been retired for, gosh, I don't know, about 16 years now. But I'm still involved in the trading industry by way of enjoytheride.world. You can see down at the bottom of the page here, a website for traders. And it keeps me active doing presentations like this. And a lot of you probably have read my tweets and my Facebook posts on my hedge strategy. Well, I've been looking critically at my hedge strategy and thinking to myself, I should look at a way to improve and simplify the hedge strategy. And I actually started thinking, how about if I create some objectives that we'll do tonight live? And when we get all done with this, if it shows what I think it shows, and I happen to know it will, because I've looked ahead, Monday, I'm going to switch to my new hedge strategy that you're going to see me develop right here. So a lot of you know that I'm currently doing 2 Keltner bands. One is a 1.5 times the ATR. The other one is the 2.5 times the ATR. And I use a 21-day because that's about a month. And being in retirement, I don't want to sit there in front of a computer all day. So I wanted to come to a way of moving to a single transaction instead of 50% of my portfolio on one hedge trade and 50% on the other, which creates two orders all the time that I've got to update. It's just a hassle. And being retired, I don't want to sit there and have to do 2 trades when I can do 1. Number 2, I want to reduce the cost of hedging. If I'm looking critically at what's happening with hedging, hedging tends to cost you money. What you're doing is reducing the risk of the portfolio. You're always, in my case, shorting SPYs, let's say, against a portfolio of stocks that you hold long. So the short on the hedge is going to make money in a down market, and the stocks are going to tend to lose money in the down market, and the two offset each other, and therefore you've basically drastically reduced your risk. The beta of my total portfolio is down to 0.3s or 0.4s versus 1 being the Standard & Poor's 500. So I have a very low risk portfolio doing this, and it's easy for me to do, so that's why I do it. I'd also like, number 3, less total trades to execute. The less trades I have to execute, the less trading costs in terms of slippage, the less hassle I've got to do to put the thing on, take it off, and so on. And finally, I'd like to use multiple indicators instead of just Keltners to offset the weakness of any single indicator. And that'll become more apparent when I show you in a little bit. So the current hedging model, as I said, was 21 days, 1.5 and 2.5. I hedge 50% of the portfolio with the 1.5 and the other 50% on the 2.5. And 2.5 goes over, that's a pretty slow moving indicator. That means we're in a pretty good bear move at that point. And I'm trying to protect against the 50% down market, which we've seen, a few times a decade over the years. And I've certainly I started trading back in the 70s heavily. So you can imagine I've seen a whole lot of bear moves over my lifetime. I like to use stops to set the point of execution because, as I was telling Dan just a little while ago, I just came off the golf course having played 9 holes to come here to give you this talk. And I like to play golf. If I'm out on a golf course on a Monday, let's say, which I'm hoping to be tomorrow, hey, the market could go over, hit a stop point, and I need the thing executed and I'm hedged. I don't have to worry about it. So I just use good till cancel stops, make it simple. Now, what I'd like to do, and we're going to check it out, and I'll show you how we're going to do that, is Keltners have some difficulties in markets where you have tightly traded markets for long periods of time, and the volatility gets less, the ATR, or the average true range, gets small, the multiplication of the 1.5 times the ATR gets small, and you have some increased probability of having potentially some trades that you'd rather not do. I like Dungeon channels as an offset to that because it's a completely different math. It uses a look back period and says, what was the highest high over that look back period? And what was the lowest low? And it draws a line across the top and the bottom. Bollinger Bands, along with Keltners, they're very similar, but Bollingers use standard deviations. Instead of ATR, they use standard deviations. Very similar concept. Standard deviations will be larger typically when the average true range is larger. So there's a lot of common threads there, but it's not exactly the same. But they're all well-known, well-used, easy to use indicators. They're on every broker platform I've ever looked at. So I thought, all right, let's look at those three. And then I'm going to use the stops to set the point of execution at the first indicator in caps to yield a signal for timeliness. So I'm going to surround the market and the noise of the market with 3 different indicators on the top, 3 different indicators on the bottom, and I'm going to say whichever one goes over first, I'm going to go ahead and either take my hedges off or put my hedges on. So given that, let's go over and look at, let's see, I got to go. All right, a lot of you have seen on my enjoytheride.world trader website on the hedge page, something that looks like this. This is a little bit stretched out. But as you can see, I've just taken, as Dan showed you, the indicator, if the low is less than, on a daily basis, the Keltner channel of 21 days for the ATR, or the average true range, and 1.5 times that. And I'm just saying, let's do the open, high, low, close 4, because somewhere that day I'd put the hedge on. If you do that, and you run a test by, as he showed you, hitting the test button, it takes seconds, if it even seconds, probably a second or 2, to run, in this case, 2,000 pieces of data, of daily data. I can just as easily say, let's go back 27 years and test it, and that takes just slightly longer, maybe 4 or 5 seconds. Now, something I got to point out here. Remember, I am hedging the stock portfolio when the market is going down. So you see this entry point. I'm really short selling an SPY. And here I'm buying it back and taking the hedge off and letting my stock portfolio enjoy the ride. Now, what does that mean in terms of the returns I'm getting here? Since TrendSpider currently, although I understand from Dan that there's some things in the work that'll change this and make it even more enhanced, right now, that assumes a buy, but I'm selling. So all you got to do is take this 1.0% for the average mean, or the mean trade, and just put a minus sign in front of it. So it's costing me on average 1% every time I do one of these hedge trades. And that's worth it to me because it reduces my volatility, it reduces my risk, in retirement. That's fine. Some people might say, that's too expensive, I don't want to do it. That's the beautiful thing about trading. Everybody can do their own thing and we can all coexist and have a good time. So this is what the 1.5 version. If I want to change this to 2.5, All I got to do is change this down here and make it a 2.5. And a lot of you who have been on my hedge page have seen that. And you could test this. And there you go. Now we got a loss of 1.83. And we have a different entries and exits. And you're working with the 2.5 line. So if we go over here and make a little matrix of this for you, I did a lot of the homework so you wouldn't have to watch me klutzing along with TrendSpider and trying to make sure everything's working right. I pre-did this for you to save some time. With the 21-day 1.5 ATR, 2,000-day, 3,000, and 7,000-day time periods, these are the number of trades that it did. These are the average returns. That should be a minus. Just noticed it. Now, as you look at all these, you realize this is, 72% is the total cost over the entire time period tested of what it costs to do that particular hedging program off of your returns. Now, if the stock market's been really good, that's why that's more negative. If the stock market's bad, then you get, like in this period, you're probably pulling in 2008. So you notice how with the longer time period, it actually costs less money because it probably picked up a bunch of profits in the 2008 sort of crash. Long periods, we've had a good stock market for a couple decades. So not surprisingly, you lose money doing hedging. The 2.5, some of the numbers are even bigger. That should be a minus. I didn't do this correct. And this should be a minus, and that should be a minus. So what you see happening here is it costs you money, and we now know if we combined 50% of the portfolio hedged here, 50% hedged there, I combine the results. These are the statistics that we're using as a starting point. Now, I had given you 4 objectives, and what we're going to try to do is go back to TrendSpider and show you how I went through a little look at a way to do it better. And I call it my 3-indicator hedging model. And so let's do that by switching my workspace. Let's see. There we go. Now, this particular, first of all, this is pretty cluttered looking. You've got the lines in the middle are your moving averages and your center points of the 3 lines on top, 3 lines on bottom. You'll see these straight lines across like this. What I have the cursor on right now, that'll be your Donchian channel because it looks back for a certain period. And so when it sees a low like where my cursor is here, until we get past the period that you've specified for the Donchian, it'll just be a straight line. As you get farther away from that, it'll finally start catching up. Meanwhile, you've got lines like this that could be Keltners or Bollingers that are starting to come up to the market a lot quicker and get to where it's going to be the first in to give you a signal. And you can see that right here on this date, for instance, if we test this and then we show on the graph, okay, why doesn't that show? All right, so what you've got then is I can quickly look at this and say, if I'm going to take off my hedges, if I'm going to put my hedges on, I'm going to look at a period like right in here where we finally are getting down to that first line on the bottom. I can put my hedge on and I can stay with it while it falls. And then it turns around and goes up and it takes out the first line right here where I've lit up. As I short here, as I buy back here, I can get my returns across a lot of data here, 7,000 bars. 58 positions is analyzed over 27 years. Total cost of hedging, in this case, was 136.23. So I hope you understand the concept I've used here in terms of getting my signals. Let's go back and go down to the 3-indicator hedging model. And let's see what, this is the benchmark that we had back with the Keltner bands that I currently have been using up through Friday. Monday, I will be moving over to something different. I got a 21-day, because everybody asked me, why do I do 21 days? 21 days is approximately a month. I'm a retired guy. I don't want to get too awfully concerned about anything that happens inside of a month. Everybody thinks of me as some trader that does stuff every day, and I do probably trade once or twice a day with various things. I might have a futures trade go over. I might have a hedge trade go over. I might buy a stock or sell a stock. I have about a 23 ETF portfolio in my IRA that I rebalance. That'll take small amounts of trades. I've got trades to get into the ETFs. I got trades to get out of the ETFs because I'm trend following those. So and I've got a counter trend trading that I'm doing with an index. So I've got a lot of things going on. Any chances of one thing happening that day are pretty good. However, I don't sit there in front of a screen all day churning out trades. So here we see with the benchmark, we can see that these are the results we got with the Keltners. These are the results I get with the 3-indicator and doing just one trade to hedge the 100% of the portfolio, and one trade to take it all off and go to 0% of the portfolio hedged. And what we're seeing, I painted green all of those numbers that turned out better according to our criteria, our objectives that we had at the beginning of the presentation. And you can see we're doing less trades, less trades, less trades. We're reducing the cost of doing the average trade, and we're reducing the total expense of all of the hedge trades combined together. So it's very clear to me that this is a more desirable way to hedge. I tested 3 indicators with 21 days in and 21 days out because I'm big on 21 days. And it turns out that if I do the 50 days in, because it's a little bit longer period, in other words, I want to shade my hedging to assume that stocks generally are risky but tend to have an upward drift over time. Value of the dollar goes down, the value of earnings goes up. In terms of nominal terms, real terms it doesn't, but nominal terms it keeps wanting to have this upward bias. So if I make it harder to get into the hedge trade by going to 50-day, but 21 days to get out, which is quicker, and that's what I showed you with the graph that I had on the TrendSpider, you can see that all of the trading gets better. You're doing less of them, in other words. The average or mean trade gets somewhat worse. However, you're doing so many less of them that it works out to where your total cost goes down. So I like the way this looks. If you end up going over, if we go back to the objectives and we move to a single transaction per each hedge trade, yes, we did that. We had less transactions. Reduced the cost of hedging over the long run, yes, we did. Less total trades to execute, absolutely. And we are using multiple indicators to offset weaknesses of any single indicator. We did that too. So to me, looking at something like this and then being able to quite easily see whichever the first line is, that's where my stop's going to be. So I put the stop in there, I go play golf, I do whatever I want. I know my portfolio will be hedged at some point. And what I'm basically doing is saying everything inside these lines is noise. Stock market just goes up and down every day and it's noise. But once it starts getting outside into the area above these top lines, the market's in an up direction. As it gets to the lower side, it's in a down direction. I always am hedged when I'm in the down direction. I always take the hedges off when I see an up direction. Keep it simple. So with that, you now have got a jump on everybody that tomorrow is going to watch my tweets and my Facebooks and rush over to enjoytheride.world hedge page and see my new approach to hedging. You have got a leg up on everybody and now know what I'm going to be doing. So any questions? Let me see. Dan, do you want to read them?
I don't see any questions for you.
Okay.
So
if anybody wants to follow this, enjoytheride.world.odoo.com is /hedging is the hedge page. The main page of the website is just enjoytheride.odoo.com. Odoo is the firm that houses the website. You can follow me on Facebook, Twitter, and Instagram. There's the information. I still intend to send out tweets on my hedge page, when I do put a hedge on or take a hedge off. So you'll get that if you follow me. And announcements on other stuff that I do, like webinars that we put on enjoytheride.world, videos that we put out, books that I've written, all sorts of, I got research papers on there you can look for free. Every time I've been interviewed, I put the link up there. This webinar, the recording of this webinar, will have a link there within a few days when Dan gets around to sending it to me, hopefully. And so it's a fun place to hang out if you're a trader, because there's a lot of free stuff there. There's a few things that you can buy there, which helps defray the cost of the website. I'm not getting rich off of it, but it's a good place to take my retirement information and put it all in one place for everybody.
This is great. Tom, there's one question from Steven. He says, are you still using the ATR to put the amount of hedges on?
I'm still using the volatility matched SPY. So what's the volatility or ATR of the Standard & Poor's 500 ETF, the SPYs, against the volatility of my entire stock portfolio on the other side. Once I know the total stock portfolio, then I can calculate how many shares of SPY do I need to do short to offset the volatility positive of my long portfolio. That's how I do the calculation. And I think I included that calculation over in the ETR tools for traders or trader tools for Excel that's available on the website. So if those of you that own that, you could look at that page and understand how I'm coming up with my numbers. And I round it to the nearest 100. You don't have to be that precise. I mean, basically, you don't know. Well, you can almost be sure. You can even go beyond that. You can also be sure that the SPY doesn't exactly match my stock portfolio because I don't own the Standard & Poor's 500. But by the same token, you know that if I have a 50% down S&P and I do very well with the hedges, I'm probably not going to do real well with my stocks. So it's a question of you want to get it in the ballpark. And I've had traders tell me they have a Far East portfolio, for instance. So they use the Asia Pacific ETF for that. Other people might have a lot of tech stocks. So maybe you want to do the NASDAQ. I'm just giving you a concept. This is education. I'm not recommending that you do it precisely like I do. I'm recommending that you take the concept, modify it, use different indicators, have fun with it, and make it your own.
Tom, I'm curious, why do you choose the index ETFs versus something like the VIX? Because I mean, SPY calls will hedge, or SPY puts will hedge, downside, but so would VIX calls.
VIX should, in a down panic, perform very well. But what if you had a VIX that was contracting? So you had a bear market that was, like a 29 crash. You get done with the day of the crash and week of the crash. And then you have this long grinding out period where we're in a depression and there's soup lines and people are out of work, and it goes on and on and on and on and on. And I'm not predicting that's going to happen, but is it possible? Yeah, geez, we've already seen it once.
Absolutely.
So what I like to try to say, I should put this one on the wall next to my other sayings that I've done over the years, but this one, and excuse the language, but the market will damn well do whatever it wants to. And sometimes when you get away from price and you start using something like VIX to actually hedge the prices of your stocks, you're getting a little bit one step removed from hedging prices. If I short the SPY, I'm hedging the Standard & Poor's 500. And I know that's what I'm trying to go after is market risk. So I'm attacking market risk with a market vehicle, not saying, well, my implication is VIX is one step removed and then talks about volatility and all that stuff. Maybe I could, trade that as well. Well, that might be a good way to hedge volatility. It might not be as good a way in my mind of hedging prices.
Makes a lot of sense. It looks like we have another question that just came in.
Right.
Stephen asks, for TrendSpider, why is the main chart showing a script under exit signal? That's not sure I fully understand that. There's multiple exit. You can configure different types of exit conditions. So when it says script, it just means a set of technical conditions, right? It's the same thing as the entry. But because on the exit side, you can also exit based on a stop loss. You can exit based on time. You can exit based on a fixed profit. So that that's why we do it that way. If you don't mind, Tom, let me take the screen here, and I can go into that in a little bit more detail.
Go ahead.
The question was, why is there a script under the exit conditions? This is also a script on the entry. It's just there's only one type of entry condition, right? It's a script. So there's no heading that says script. But there's multiple types of exits, right? You can exit candles past, so we're on a daily chart, so that means exit after 30 trading days. You can exit, on a profit taker. So if you're up 5%, just get out, take the money and run, right? And you can also exit on a stop loss. So there's 4 different types of exits, and you can choose which ones you want to use in the backtest, right? By configuring it here. So like this configuration right here will trade based on the MACD. Let me get rid of this condition here because we were just experimenting with that one earlier. But it'll trade based on the MACD, but it's also going to get out if the trades, last for too long, if you make money, or if you lose too much, right? And you can see when you put the trades on the chart, it's going to tell you the type of exit it took, right? So like this exit here was a script exit, and it was also a stop loss exit. They happened together. This one was a take profit. You're up more than 5%, so exit on that candle, and so forth. Right. You will find when you're backtesting that these types of exits, take profit and stop loss, can very much skew your results. And that's important. I think anybody who trades understands the importance of managing risk and taking profits, right? We're not here to invest and buy and hold things for decades, right? We're here to, get in, get out, and take our, profits. So these conditions let you control that. Stephen also asked when we can backtest short selling. The actual short conditions will be coming. I don't have a timeline, but I would say this year, within the next few months. I mean, it's something we've talked about a lot. Tom has asked us for that a lot, and a lot of people have. But in the meanwhile, you can always just invert the numbers, right? If this were a short strategy, you'd be negative 35%, 0.35% instead of positive. One thing I do want to quickly show everybody, because it is related to this, when you're doing a strategy like the one that Tom is backtesting here, you can also put that strategy to work. So let's say you test it. I'm keeping this simple. This is just Bollinger Bands. I don't have the other 3 types of volatility kind of bands on this chart. But if your trigger is when price breaks above this green top Bollinger Band line, you can always right click on it in TrendSpider, and you can create an alert that will fire off when price breaks it, touches it, or bounces off it, or any combination that you want. and you can control a buffer zone around it, right? And the buffer zone is important because it, as you know, price doesn't always get directly up to the line that you're monitoring. You know, there's a lot of people watching the Bollinger Band top and bottom lines. You know, and there's a lot of people who see price approaching it and jump into, you know, trade, you know, sell it short or buy it, go long or whatever before price actually hits it, because their anticipation is that price won't actually hit it. And you can actually see that playing out right here, you know, on this candle right here, right? If you put a little arrow, oops, sorry, I have to pick the arrow tool. But if you put a little arrow here, oh, my arrows are white. That's why I can't see them. Duh. But if you put a little arrow here, you can see that price did not actually touch this lower Bollinger Band here. It came close to it. So if I was, if my strategy was to, you know, do something when price interacted with that, I might want to create an alert on that line. And knowing that price doesn't always get directly up to it, you know, I may want to set a different buffer period here, something to make sure that I can get in. So if there's no other questions, and it doesn't look like there are, I just want to say thank you to everybody for being here. Tom, you know, thank you so much for coming on. You know, this is now your second time on with us, and your insights are priceless, and I know everyone appreciates them.
It's
if
my
anyone wants
pleasure.
to learn more about Tom, you can visit his website. I will post this info in the chat. You can also visit him on Twitter. And if anyone's interested in trying TrendSpider, you can do that as well. And we offer a 15% discount, you know, after your free trial. So with that said, thank you again, everybody. Tom, thank you for being here.
Thank you.
All right, everyone, have a wonderful evening. I appreciate you being here with us on a Sunday, and talk to you guys next week. Goodbye.